If you don't use fair value gaps, you're clearly living under a rock, because fair value gaps is the reason why I was able to go from a 40% win rate all the way up to a 72% win rate. Fair value gaps has been a game changer for me, and I'm about to explain to you exactly what is a fair value gap, how to identify fair value gaps, and how to enter off fair value gaps. So let's get right into it. So let's talk about what are fair value gaps. So let's draw out a market real quick. Let's say we're drawing out an uptrend like this. Now, first thing first, when we see an uptrend, what are we identifying? We are identifying higher highs and higher lows. So every time we create a higher high, we actually have something called a break of structure, which is this one right here, this one right here, these levels right here. And every time we have this break of structure, you will notice that price tends to pull back to a certain area and then continue to move forward. And what we call this certain area, or what we want to see in this certain area, is basically price filling up something called an imbalance. And what an imbalance is from this level to this level, we had a huge volume of buyers. And so the market is like a seesaw. I like to kind of break it down like this. And we have buyers versus sellers, and they have to be equal at all times. Because if you buy something and there's no sellers, then you won't be able to make profit. And if you sell something and you can't find buyers, you won't be able to make profit either. So buyers and sellers always have to be equal. So if there's 10 buyers, there has to be 10 sellers in order for these buyers to close their trade in the market. Now, what happens if there are more buyers? Well, the market has to now give a movement for the sellers. And that's what we call this area right here, which we call quote unquote retracement. So this pull downwards is called a retracement. And so as soon as the buyers and sellers have become equal, then we get a reversal and price starts to continue to go in the direction it needs to go in. That's why we don't see markets just going up in one direction and you don't see it going down in one direction. You always see it go up and down, up and down, up and down, and it keeps doing that. So what happens if, let's say, for example, in a downtrend and we get a huge drop in the market, like let's say like this, well, we're going to see that price is going up. And when price goes up, that means we're sucking in the buyers. We're like trapping the buyers, trying to get them to buy in the market, which then gives opportunities for sellers to continue the selling move, which then causes this trend that we got going on. And so that is basically what a imbalance is. And so what is a fair value gap? A fair value gap is a 3 candlestick pattern. And what that 3 candlestick pattern is, and I'm going to try my best to draw this as good as possible, but let's say we have 3 downwards candlesticks like this. And as you can see, these 3 candlesticks right here, it doesn't matter what color they are, it doesn't matter if they're bullish or they're bearish, it doesn't matter what it is, as long as there's 3 candlesticks involved, you will notice that we've got candlestick number 1, candlestick number 2, and candlestick number 3. Now, if we're on a downtrend, what we do is, and we can write notes on this, but what we do is we are going to draw a line from the lowest point of the first candlestick, and that would be including the wicks. So we draw a line from the lowest point. And then what we do is we skip the second candlestick and we go for the third candlestick and we draw out the highest point and we draw a line from the highest point, including the wick. And you notice that we have this little void right here. Now, this void is where buyers and sellers are going to have a battle. And this battle is going to determine whether we are going to continue to go down or we are going to reverse and go to the upside. And so this is where majority of traders are going to try and look for trades. And so what we need to do as a trader is we need to wait for price to go into this area like this. And once we see who wins the battle, let's say sellers win the battle and it comes out like this, you can place a trade and continue the trend. And that's basically what a fair value gap is. So I'll write down the notes so you guys can write this down too. So if we're in a downtrend, so I'm going to write downtrend. And it'll be the opposite for an uptrend, which we'll write notes on. You will mark up the lowest point of the candlestick. My spelling is horrendous. Mark up then you will mark the highest point of the third candlestick. If there is a void, that will be a FVG. Exactly like that. Okay. And I'll do this so you can actually see a quick. So pause the video and write down these notes because these notes are very, very important. And it's the opposite for an uptrend. So let me remove this. Let's say now we see 3 candlesticks going towards the upside. So 1, 2, and you'll notice that the 2 is always quite big, and 3. And so we draw a line from the highest, this time it'll be the highest point of the first candlestick, and the low, sorry about that line, and then the lowest point of the third candlestick. And you'll see that we have this void here, and all we want price to do is go into this void, and then come out of this void, and that's a valid fair value gap. And so it'll be the opposite. So we would, for uptrend, you will mark the highest point for the first candlestick. You will then mark the lowest point of the third candlestick. If there is a void, that will be a FVG. Okay, what we're going to do now is, I'll just put this up here so you guys can actually see that. What we'll do now is we'll go onto the charts and we'll actually locate some fair value gaps, and I'll show you how they get respected and how you can actually trade off them. So let's first start identifying some fair value gaps, and I want you to try this out for yourself as well. So let's mark up some fair value gaps. So as you can see, we had a big push to the upside. So all we're doing is we're going to find 3 candlesticks. You can see we've got 1, 2, 3. All I'm going to do is I'm going to draw a line from or a box from here to here. Boom. As you can see, price goes in, it comes out, and as you can see, it goes and continues in that direction. Let's show some more so you can actually visually see. Again, we had a really big push to the upside. You can see we actually had a bullish breaker structure. As soon as you see a breaker structure, just notice that you are going to start looking for a fair value gap. Like, make that a trigger point. As soon as you see a breaker structure, you then look for a fair value gap. And so we see a breaker structure right here. Okay, start to identify some fair value gaps. As you can see, the 1, 2, 3, these 3 candlesticks, the high and low of the candlestick, it kind of overlaps. So there's no fair value gap. But over here, you can see that there is a fair value gap because it respects right here. Then we have another fair value gap, as you can see right here. You can see it respects. And as you can see, both of these fair value gaps get respected. And so what do we do in this circumstance if we have fair value gaps that are getting respected? Well, first thing first, what I'll do is I'll say, okay, does price tap into this fair value gap? Yes. Okay, we can remove this fair value gap. This is the most valid fair value gap. The reason why is because it respected this fair value gap more than the other, because as you can see, we had price action going in it as well. And so that's what's going to help you when identifying when the fair value gaps are stacked up, just like that. And I'll show you more examples where hopefully we can find one where it actually disrespects stacked up, one of the stacked up fair value gaps. Let's have a look. I'm trying to find one where it disrespects. I don't think we can actually see. So I'm trying to locate one where it disrespects the fair value gap, and I can't really locate one where there is a disrespect of a fair value gap. Okay, let's have a look over here. Look, as you can see, we got stacked up or fair value gaps. This is not really the best example for a disrespect of a fair value gap. However, we can still draw out all the fair value gaps that we can see. So we got one right here. Then we got another one right here. And as you can see, this one never got tapped in. Obviously, over here it does, but the initial move that causes price to continue to go up, as you can see, this fair value gap never got tapped. So as soon as we catch a move, let's say order flow out of here, the first thing you can do is just remove this fair value gap, because that's clearly not the one that's getting respected, and then you can see the markets move and push towards the upside. And that's how you start to identify fair value gaps. Now let's break down the system and actually get it to a point where we can actually look for entries, because it's easy for me to go on the 1 hour time frame and start locating fair value gaps and show you that it goes in the direction. But how do we actually look for entries using fair value gaps? How do we actually enter off a fair value gap to make sure that we can increase our win rate? So what you want to do is you want to, on the hourly time frame, or what I like to do is I like to first locate a liquidity sweep. So as you can see over here, we actually have a liquidity sweep right here. So as soon as I see a liquidity sweep, and I'm just going to mark this up, I'll go on the replay bar tool, start new. We got a liquidity sweep right here. As soon as I see a liquidity sweep, I'm going to go straight into 5 minutes. I'm looking for a bullish breaker structure. As you can see, we got a bullish breaker structure right here. So I'm going to mark that in red. And if you want to know my system, you can go check out my other videos, but I'm just kind of speed running through the other breaker structure and liquidity. I've made videos on that. If you want to check it out, make sure you go check it out on my channel. Now, once and I'm going to color coordinate this red. Now, once you see that, the red breaker structure, we're now looking for fair value gaps. Exactly. And so we start looking for fair value gaps. As you can see, we've got one right here. Do we have any more? No, we don't. The one over here overlaps, this high and this low overlaps. There's no void. This is the only void. So all we're looking for is price to go in, which it does. And we're looking for a candlestick coming out, which we get. We can then look for a long position, just like that. And did you notice something? We didn't enter off the fair value gap once it goes in. We always wait for a candlestick order flow coming out. Now, if it's a bullish fair value gap, we're looking for a bullish candlestick. If it's a bearish fair value gap, we're looking for a bearish candlestick coming out. Yes, some may argue that why don't we just have resting orders right here? But the thing is, if you have resting orders right here, what is the reasoning, or what's the theory of the market actually respecting that? It doesn't have to respect the fair value gap. This is just a thesis. The only time we know that it respects the fair value gap is once we get the bullish order flow. As soon as we get that, we can keep our stop loss just below these lows, and then we can just target whatever. Let's say we just target liquidity highs. Let's say we just target all the way up to here. Let's just say, for example, we'll have other TPs right here. Let's see exactly what happens. Now, another thing is, where did I put my stop loss placement, and why was my stop loss placement below this candlestick low? The reason why it's below this candlestick low is because we formed a fair value gap here. If price wants to come down and disrespect this fair value gap, fair enough, but then that would cause a change of character, meaning that price is now going in the other direction, and therefore I would like to be out of the market. Now, you can be very reserved and put your stop loss all the way below the actual liquidity low, which I do sometimes. However, in this scenario, I can see that that stop loss is way too big for me, and this is a little bit more of an aggressive approach. However, let's see what the outcome happens. Do we get, and there we go, we get TP hit. And I'm so confident with this. We can keep going and backtest this. I backtest this regularly on gold, and you'll notice that every time you enter off the fair value gap, and 5 minutes is a sweet spot. I know some traders use a 1 minute. I sometimes use a 1 minute too. However, I found, based on my data, that the 5 minutes, going from the 1 hour to the 5 minute, is one of the best time frame change that you could have, right? Scaling into the 5 minute is synchronized really well, and waiting for that 5 minute, waiting for the candlestick close, and waiting for a order flow to actually come out of the fair value gap to validate it, because that's a big mistake that a lot of traders make, is they never wait for a fair value gap to actually be validated. They will enter in a fair value gap. So just to give you some key rules with fair value gaps, which we'll write down on the top over here. Key rules: never enter off a FVG, never enter inside an FVG. Okay, another one, never, always wait for order flow to come out of, of FVG. And another rule is always place your stop loss below the candlestick low that caused the FVG. So usually that's the second candlestick. So you see this, right? This candlestick here, the second candlestick that we never really used, it would always be the low of that second. So we've got 1, 2, 3. The second candlestick low would be the stop loss. And now, what if we have stacked up fair value gaps? Let's just say, let me actually find an example where we have stacked up fair value gaps. Like for example here, we have stacked up fair value gaps right here. 1, 2. This is a very small one, but it still counts. And then another third one, which is really, really small, but it still counts. Now we have stacked up fair value gaps. Let's say we enter. Okay, we don't really get order flow. Actually, we do. We get bearish order flow coming out over here. Short position straight away, just as we like that. Now, where would we keep our stop loss here? Because if we keep it above here, there's room for price to go into this fair value gap. So this is what I would do. I would always keep my price above all the fair value gaps because it gives price room for it to go into one of these fair value gaps if it wants to. And as you can see, it doesn't hit full TP. I mean, we don't even get a 1-to-1 out of this. However, there's probably reasonings to this, yeah, because we're going in the opposite direction. However, as you can see, we can still capitalize off this if we just target liquidity lows, for example, like these lows. And we could probably even target these lows and continue the trend. But as you can see, it doesn't actually work out in this scenario. Just to be transparent with you, the reason why it doesn't work out is because we're going against the trend. As you can see, the trend is clearly on an uptrend. So never ever, that's actually another rule that I want to put in. And I'm actually happy we saw that, is never trade against the trend. Always remember that. Never, ever, ever trade against the trend. If you trade against the trend, you're never, ever going to win in the markets, even if you know how to use fair value gaps, even if you know how to use liquidity, even if you know how to use breaker structure. Now, if you want to watch any of my other videos that helps you with regards to this entry model, which involves liquidity and breaker structure, make sure you go check it out on my channel. If you haven't subscribed to my channel, make sure you subscribe, like this video, comment down below if there was anything that you didn't understand, or comment down below the rules or the notes that you've made to help other traders. I think that'll be very, very helpful for traders. And I'll see you in the next video.